Hello, dear member. Welcome to this series of e-learning. Today, we'll be discussing SA210 that talks about agreeing the terms of audit engagement. Frankly speaking, it is very important for all of us, all our members, to understand and undertake any assignment with a complete understanding and our clients and us on the same page as far as the conduct of the audit is concerned. Further, it is important for us to know that every audit that we conduct, okay, it has to be conducted with not only the expectations of the person engaging us for the audit, but also with the intended user of the financial statement. So each of our standard works on the same basis, and therefore while agreeing the terms, it is necessary that all of us are on the same page so that we don't miscommunicate through our audit. As we all know, the entire structure of this audit standard is divided into this introduction, objectives, definition, requirements, and application guides and appendices. Let's move forward. The scope of this particular essay is auditor's responsibility in agreeing the terms with the management and those charged with the governance. There are several facets to this which we will be discussing during the course of our this e-learning session. Every standard has an objective. So in this case, the objective of this standard is to ensure or enable our member to understand, establish and confirm that any audit that needs to be undertaken, there exists a precondition for the audit. Okay, and we need to confirm that the common understanding of terms of audit engagement between the auditor management are arrived at. What are the preconditions of an audit? Please note that when we say audit, anytime we sign a financial statement with a terminology called audit, it basically presupposes, it implies that the financial statements signed by a chartered accountant adhere to acceptable financial reporting framework. What is that financial reporting framework? For a member like us, it is the audit accounting standards. And when we conduct the audit, when I say I've conducted the audit, it implies that I have adhered to the auditing standards. So it is necessary that the financial statements that we audit adhere to the accounting standards and other financial reporting framework, which would mean accounting standards, relevant regulations of that entity, specific reporting requirements of the various regulators. All of this put together comprise of the financial reporting framework. So when we undertake any audit, we need to understand which that segment, that particular entity belongs to. What are the financial reporting requirements? What are the accounting standards applicable? What all are the different disclosure norms required by the respective regulator? or the intended user, and accordingly we need to establish that yes, those preconditions exist with the financial statement that will be audited. So this particular slide explains the same thing in details as to we need to determine and obtain both the acceptability of the financial reporting framework, okay, and whether management is in agreement that it understands its responsibility. Preparation of financial statement in accordance with the financial framework, internal controls, and all relevant information and unrestricted access, of course. Unless we have established that these things are available, it would be difficult for us to ultimately conclude. Like I said earlier, what are the different factors determining the acceptability? The nature of entity, like I said earlier, which particular, whether it is governed by a particular regulator or governed by a particular act, the purpose for which we are being asked to sign the financial statements or audit the financial statements, and the nature. Many times you will find that the acceptable norms with the institute and the regulator, there are small differences. We'll come to those aspects later. How do you deal with it? Deficiencies in applicable FRF, that is Financial Reporting Framework, may be encountered after engagement acceptance. In such cases, management may decide to use another FRF. This becomes a new terms of audit engagement. We also need to make management understand its responsibility. The independence of the audit basically means that auditor should not be involved in preparation of financial statements of an entity. The independence would be construed to be lost if it is established. And the auditor has a reasonable expectations of obtaining information necessary for the audit. Please note, at any given point of time, during the course of agreeing to accept the assignment, if management does not acknowledge its responsibility or agrees to provide a written representation, okay, auditor will be unable to obtain sufficient information. So at this point of time, auditor may consider whether to accept or not to accept. If he accepts, what would be the impact on the audit report? So one may decide to accept and give sufficient clarifications in his audit report. Either way, each member will have to take a call. Preconditions of audit, sometimes they may be imposed by the management. If they are imposed prior to the engagement, okay, as I said earlier, there could be implications in the audit report. If management is not agreeable for the audit report implication, then it would be worthwhile not to accept the audit engagement. Because when a chartered accountant signs and considers it to be an audited statement, it means certain framework for the intended user. And if we are not able to achieve that, probably it would be misleading, and therefore it would be advisable not to accept such assignments. Hence, every assignment, many times, friends, you will observe that while accepting the assignment, there is a general statement saying that we need a value addition. The question arises as to what do you mean by value addition? We should not be lured or swayed away by such terms. We should always specifically say, Sir, I don't understand what do you mean by value addition. If you tell me where the shoe pinches, I will fix it. And therefore, because if you accept, you leave a room for interpretation and expression of dissatisfaction which you never expected or which was never intended during the course of audit. And therefore, every time we accept the communication with the person engaging you for the audit, we need to completely on the same page so that we are able to concentrate and deliver accordingly. So obviously, the standard provides the guidelines on to how we should be actually going ahead with this and how the audit engagement terms should be fixed, which includes objective scope, auditor's responsibility, management responsibility, identification of applicable FRF, expected form and content of the report. If it is not stipulated by any laws or regulations. For a recurring audit, every time when we get it started, we need to revisit whether the circumstances require any revision and need to remind the entity of existence. Friends, I would like to divert a little here from our slides and tell you that during the course of my profession, I've realized, you know, whenever I have uh, interacted with various professionals in the Western countries, in some other countries, even small practitioner or a large practitioner, every practitioner would have a standard set of certain papers which he gets signed by his engagement on entity. It is necessary that every one of us has kept certain standard formats for our office so that we are always seen as a meticulous and disciplinary players in the market. So friends, on this note, we must accept the audit or even the change of terms if only if they are agreeable to us. If we are unable to agree with changed terms of audit engagements, okay, which is not permitted by management to continue, okay, we may consider withdrawing if permitted by law or determine the need to report accordingly. And if the terms are changed, auditors and management shall agree with the new terms and record the new terms in the engagement letter. So fresh engagement letter is advisable in such cases, rather mandatory in such cases. There are a few more additional considerations that we may have to undertake. Okay, there is a possibility that there exists a conflict between the standards and the additional requirements. Okay, there is a possibility that a particular law specifies certain things and our accounting standard actually, as it is generally understood, expects a different thing. How do we resolve this conflict? We need to discuss this with the management, the additional requirements. So If there are few reporting requirements by our audit or accounting standards which are not mandated under the respective framework, it may call for additional disclosures in your financial statements. So we must agree whether additional requirements can be met through additional disclosures, whether financial reporting framework in financial statement can be amended accordingly, or if neither is possible, consider the audit opinion. There are few simple things like there are certain acts where the format of balance sheets given by the respective act does not provide for above the line over the below the line concept. Everything is profit carried to profit and loss account. There could be situations where certain reserves are reversed. There could be certain situations where the reserves created out of the profits are required to be reversed, and they are considered under the same set. Now, we will have to think whether additional disclosure would be necessary for a reader to understand that this particular item is actually not the profit and loss item but is through the reserves. Something like that. So, there are several such things that we will have to consider additional reportings if the act of that entity does not provide. If the management is not agreeable, we may have to consider whether we should continue with such assignments. We'll have to evaluate whether the users might misunderstand the outcome of the audit. For example, one more thing I would like to specify here. In case of a tax audit, which is not for the entity which is incorporated, say partnership firms, or there are several such entities where there is no audit requirement, but audits are conducted because of say tax reasons or because of the banks, etc., etc. Now, it is necessary for us to understand that yes, this particular intended user is whom, and generally when the tax audit reports are submitted as audited statement, we cannot only consider those financial statements to ensure that the tax point of view has been complied with. When we say it's audit, it is necessary that we fulfill the requirement of financial reporting framework. Now, such misunderstanding must be avoided when we undertake the audit. So, whenever such assignments are of audit are undertaken, we must understand the intended user, we must understand the financial reporting framework, and we must understand the difference that arises between the regulator or the act and their prescribed accounting standards and auditing standards. The gaps will have to be fulfilled through either disclosures or opinions. Thank you, sir.